What if your money grew no matter what the market did? Today, we will show you how to build a bulletproof investment portfolio that works in any economy, recession or boom. Simple, smart, effective. You can be smart because it's actually simple. The idea of an investment portfolio started in the 1950s with a man named Harry Markowitz. He proved that putting your money into different types of investments, not just one, helps lower your risk while still growing your wealth. That idea won him a Nobel Prize and became the foundation of modern investing. Since then, investors like Warren Buffett, Ray Dalio, and John Bogle have taken that concept and built it into a strategy used by millions. Buffett suggests most people stick to a simple, broad mix of big established companies. Dalio designed a portfolio that performs well in any economy.
The best way to structure a portfolio is to have the right kind of balance in your portfolio.
And Bogle made it possible for everyday people to invest in entire markets with low-cost index funds.
Put half of it in Wellington Fund and half of it in Balanced Index Fund. The idea was not all in Balanced Index Fund because there could be things that happen that a manager needs to adjust to.
In this video, you'll learn what kinds of assets belong in a well-diversified portfolio, how to choose the right mix based on your life stage and risk level, and most importantly, how to adjust your portfolio depending on the state of the economy.
But it's not that the case of having a recession is, I don't rule that out either. It's possible that we will have what I hope would be a mild recession.
Fear spread in the month of September 2008 at a rate that was like a tsunami.
This video isn't financial advice. It's a simplified strategy based on the thinking of the smartest investors out there. But it has an edge. The edge is the small tweaks you make in the different economic conditions. Let's kick it off with the foundation, a medium risk portfolio. The reason we start here is because it gives you a balanced, flexible starting point that you can adjust as your life or the economy changes. The idea is to spread your capital across assets that perform differently depending on what's happening in the world. We break this portfolio into 5 main buckets. Stocks. The first is stocks. This is your engine for long-term growth. Stocks give you exposure to business innovation and global productivity. When companies grow, your portfolio grows. It's also where most long-term wealth is built. In this version, we allocate 40% to stocks. Bonds. Next up is bonds at 25%.
Treasuries have proven always to be a reliable safe haven investment.
Recession fears have caused investors to flee to safe investments like Treasury bonds.
U.S. Treasury bonds are a pretty safe investment.
Nothing can touch them.
Bonds act as a stabilizer. They don't grow as fast as stocks, but they're more reliable. They provide steady income and usually hold up better when markets get choppy.
Here you are, kid. Merry Christmas.
Thank you.
Think of bonds as the counterbalance that keeps your portfolio from veering off course. Crypto. Then there's crypto, which we give a 10% allocation.
The United States will be the crypto capital of the planet and the Bitcoin superpower of the world, and we'll get it done.
Now, crypto is volatile, there's no denying that. But it also offers what's called asymmetric upside. In other words, the potential returns are high relative to the amount invested. You don't need to bet the house. A small allocation gives you exposure to a fast-moving, high-growth part of the financial future. Cash. Cash and cash equivalents make up another 10%. This is your optionality. It gives you the freedom to buy dips, ride out tough periods, or simply stay calm when others are panicking. Cash lets you act from strength, not fear. Alternative assets. Finally, 15% goes into alternative assets. This could include real estate, gold, oil, private equity, infrastructure, anything that doesn't move in sync with the stock market. These assets give your portfolio even more resilience. Now, if you want to know exactly how to build each of those buckets, we've got deep dive videos on the way. And yes, our crypto portfolio, it's spicy. So, why go through all this effort to split your portfolio across different types of assets?
It's been higher than that, and been lower than that, but right now I'm very comfortable at 50-50. Although I spend half my time worrying that I have too much in stocks, and the other half of my time worrying that I have too little in stocks.
Why not just go all in on what's hot? Because the key to long-term investing isn't predicting the future. It's being prepared for it. As Ray Dalio says, diversification is the only free lunch in investing.
If I have 15 good uncorrelated bets, I will reduce my risk by 80% without reducing my return. And that means I improve my return to risk ratio by a factor of 5.
By spreading your bets, you reduce the chances of one bad move wiping out your gains. But before we go further, you need to check in with yourself. A portfolio isn't one size fits all. It has to match where you are in life. If you're in your 30s with time on your side, you can afford to take on more risk. That means a higher allocation to stocks and crypto, more growth, more volatility, but time is your safety net. If you're 65 and close to retirement, your priorities shift. You want to protect what you've built and generate steady income. That means leaning more into bonds and cash and scaling back on stocks and crypto. Knowing your risk profile isn't optional. It's essential. Now here's where the real advantage kicks in. This is the part that most investors ignore. It's the reason people with similar portfolios can end up with totally different results. Because the economy isn't static, and your portfolio shouldn't be either. There are 4 major economic environments. These are the conditions that shape how assets perform. Learning how to recognize them and adjust your portfolio accordingly is what separates average investors from the truly successful. Let's start with the first one, inflationary periods.
Inflation is causing stress. Bad news about prices in the grocery store.
Historically high inflation.
This is when prices are rising across the board. Groceries, rent, energy, it all starts to cost more. Your money doesn't go as far, and central banks usually respond by raising interest rates to slow things down. In these periods, real assets tend to do well. Commodities like gold and oil, real estate, and sometimes even certain stocks, especially in energy or utilities, can hold their value better than others. Inflation eats away at cash.
Inflation robs every American, every one of you.
So you want to own things that rise with it. Next is deflationary periods. This is when prices are falling, not because things are getting better, but because people have stopped spending. Companies slash prices to attract buyers, layoffs increase, the economy slows. It sounds nice on the surface, cheaper prices, but deflation is dangerous. It leads to a slowdown in growth and a rise in uncertainty.
The problem with persistent and substantial deflation is if you know you're going to buy something cheaper in the future than you could buy it today, why would you buy it now?
In these periods, long-term government bonds tend to perform well. Interest rates usually drop, which increases bond prices. These become your safe income-generating assets while everything else is pulling back. Third, economic growth. This is the ideal scenario. People are spending, businesses are hiring, and GDP is climbing. This is when stocks and even crypto tend to do well. The economy is expanding and risk-taking is rewarded. You want more exposure to growth sectors. It's a time to build, not hide. And finally, there's an economic slowdown. This one isn't as dramatic as a crash, but it's a clear sign the economy is cooling off. People pull back on spending, hiring slows, and uncertainty creeps in. Recession headlines start creeping in. You start to feel the brakes, even if the car hasn't stopped moving. Here, defensive assets are key. Sectors like healthcare, consumer staples, and utilities tend to hold up better. You'll also want more weight in high-quality bonds and cash. These give you stability, while others are feeling the squeeze. Understanding these four environments and knowing how to adjust your portfolio for each gives you an edge that most investors never develop. This is how you go from having a random collection of investments to building a real, responsive strategy. Because the best portfolio isn't the one that performs best in any one year. It's the one that performs well across many years, and that's the goal.